Pro traders are good to go with today's market movers from CME Group.
Welcome to Market Movers. I'm Jim Iuorio, and we are now one full year into the presidency of Donald Trump, and it's been an outstanding year for U.S. equities. Today we're going to discuss the implications of this administration, plus any other exogenous factors that may have influenced stocks before and going forward. We're going to be looking at using the NQ, the NASDAQ mini options, as a way of expressing risk appetite in this current environment. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, give me the single biggest reason for the rally over the last year.
I think it's sentiment, to be honest. I think it's the outlook.
What caused the sentiment? That's what I'm asking you.
It's the outlook, my friend. It's the fact that we have an administration that, in theory, in talk, and not so much in policy yet, that at least I believe has expressed a little bit better sentiment when it comes to businesses and helping businesses grow with taxes and so forth.
I don't see how anyone can argue that point, and I'm being serious. And there are people who say
there are surveys that back this up.
There are surveys that back this up. There's no question about it. I will add that I truly believe that the overarching backbeat, whatever you want to call it, of low interest rates is doing the same thing. Because the Fed doesn't know what to do because they want to see some actual visual signs that things are getting better, so they keep rates low.
Fair. And I'll tell you something else, though, real quick, to throw you a bone, is the economic data had started to increase into the election anyway.
No doubt.
So it's likely that momentum continued, at least into the first half of the year, which you saw in the jobs and GDP reports.
Are we overconfident in a tax cut?
Yeah, absolutely, because that's what the market's hanging on. And every day that we see that coming down, you see a couple points shaved off the S&P.
Right, I think we will get something. Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary. The DEES E-mini NASDAQ contract was trading 63.38 when we priced this up, Scott.
So you talked about overconfidence, which I think is kind of prevalent in the markets, and that's what makes a great bull market anyway, is this confidence level. And to me, Jim, the market seems to be suffering from a little bit of acrophobia, fear of heights here.
Okay.
So yeah, see, that's a little vocabulary lesson there, which is making me look at put spreads today, believe it or not. We saw a spike in the VIX leading into this week, and that followed through into Wednesday today. So I looked at some put spreads today. Even though I want to express myself bullishly, I actually am selling a put spread because I believe you can get some pretty favorable risk reward and put spreads that are out there in the NQ. Specifically, looking at the week one DEES, 6250, 6200 put spread in the NQs for 11 ticks. It expires DEES 1. It has the NQ as the underlying currently at 63.38. It's going to risk 780, so that's a pretty big risk to put out there to make the potential 220 you receive for selling that put spread. The reason I picked those levels, though, is if you look at the breakout in the NQs over the last, say, couple weeks, it's right at those levels. So I believe if we do come back, it's not going to fill out that put spread, and therefore you're bringing in the premium.
I do like the trade. I love selling put premium, and the decay is your friend. I don't like that it's 3 weeks, but in this particular case, I think you get what you sell. I mean, 11 ticks seems like a lot for this. So I don't not like it. I do like it. So I'm buying the week one DEES 64.10, 64.40 call spread for 10.5 ticks. It's kind of like the polar opposite of your trade to express the same view. It expires December 1st as well, has NQ underlying, and it risks $210 to make a potential 390. Again, it's just a call spread. Neither of us in this relatively low vol environment would just buy a call or buy a put. We always have to sell as well.
I like defining risk, yes.
Yeah.
And I'll tell you what's interesting, that the way you put it was perfect. It's a similar expression, but two different ways to do it with different levels. So I would almost say you could use them both and still get this. If you agree with the expression, you could use them both and therefore have different expressions on, though. And that's what's very unique about the things we talk about here, is so many different ways to express a similar view.
I like it. I like it. Thanks for joining us on Market Movers. I'm Jim Iuorio, where we're hoping to make you a better trader.